via email. And we have 3 questions. First from Mark K, and then from Scott O, and then from Josh C. Now, Mark K sent this to me this afternoon. I didn't put a lot of slides together for this, and initially I was going to step away from this, but that's not really fair to Mark, and it's not really fair to Power Options subscribers and Power Options users. Mark says, I'm 72 years old and retired. I have many high-yielding dividend stocks, and I live off these dividends. I have large gains in most of them. For example, ABBV, which is I think around $179, $180, and a cost basis of $79. And I'm going to keep these stocks forever and live off the dividends. However, I do want to sleep at night, and I want to protect the gain in the stock and prevent losses due to market corrections. I do have protective puts, as you recommend, through the Married Put techniques at RadioActive Trading on all of my stocks. And per the rules in the blueprint, I keep rolling them up via income method number 4 as the stocks increase in price, but I'm not sure if this is still the right strategy, since I'm never going to sell these stocks and the put costs increase with every roll. We covered this last week, where we talked about income method number 4 and maybe when to consider stop using income method number 4. Because we pay a debit to roll up the put, but the debit, done correctly, is always less than the difference in the strike prices. So you're still getting a benefit, though you are taking away upside profit. I know I'm guaranteed a higher price when I roll up the put, Mark says, but I'm never going to sell the stocks. As I don't recall ever you discussing how a retiree like myself could benefit from the Power Option strategies when there's no intention to sell any of the stocks. I would appreciate if you could discuss this, and thank you for your help in the past. Now, my initial sort of comment was that I didn't think I was going to go too in-depth with this during the seminar, other than to simply say, yes. If you asked Ernie this question on a coaching session, you asked me this question on a coaching session, you called up with this thought, this question, this concern. Ernie especially would say he feels that protecting the positions as you're doing is the right approach and the approach we would suggest. Ernie's in his 80s. He's protecting that nest egg and using these positions. It saved his bacon in 2008, where he kept most of the money he had in the market at that time. Only saw a drawdown of about 3 or 4% during the fall of 2008 to 2009 and was able to recuperate and see higher gains going forward because of that. We'll talk about that in a moment. If you feel that you are adding too much to the cost basis by rolling, then you may want to purchase the initial put as far out as possible, slightly in the money, which we recommend to start, and then just evaluate the insurance policy every 6 months or so. You don't necessarily have to move it up each time it moves to the next strike level or goes above the put strike price. You can wait for that, and you still might have a reasonable cost to buy the next higher strike put up or 3 or 4 strikes up if you let it go. But again, you're getting much more in guaranteed payout than you're paying to move up the put. Most investors in this situation have moved away from selling calls against the positions as an income. Hey, I'm going to hold this forever. I'm getting the dividend. Let me just pick a strike where I don't think the stock is going to hit. Well, as the last 6 months have shown us, and other times over the last 3 years, that can quickly be exceeded in unprecedented market movements to the upside in investor optimism. You end up having to roll those calls to pay more to avoid being assigned because you want to hold these stocks forever. Now, I did say I would check with Ernie, see if he has any other thoughts. Didn't get a chance to touch base with him, but as far as trading other strategies on these securities, we feel that might overcomplicate the issue and the goals for the long-term holdings. And what I meant by that is we've had previous discussions where an investor has said, hey, instead of doing the married put approach or protecting stocks long-term, why don't I have a lower cost and protect the position with, say, a bear put debit spread, where I'm buying a put and selling a lower strike put, so if the stock falls, I get the difference in the strike prices. Well, that's great. If it only falls 5 or 10 points, and you get most of that 5 or 10 points back. If it falls 20 points, you only get 5 points back. It didn't work as a proper hedge. Doing other things with a put to try to create a put spread or ratio put spread for the insurance, now I don't think that's what you want to do to overcomplicate the position. And again, it doesn't work as well as just the one-to-one protection that you're doing with the stock position. Now, Mark mentioned ABBV. Let's take ABBV. And standard view that I have, which we're going to come back to for one of our other questions via email, is just looking at a 3-month chart when I'm looking to open a new position. And I have some of these models selected, but we're going to talk about that in a moment. For Marc mentioned, I look at the 3-month chart for ABBV, and I say, yeah, okay, it's gone up just in the last 3 months from 152-ish, peaked at around 182, and we're at that 179 range right now. I don't think I need a put with this. It's been moving up the past 3 months. I probably crossed one dividend. Everything is well. The put was just extra cost. I likely would have rolled this maybe 2 times, maybe 3 times, just looking at the chart itself without looking at the options prices. But does he need it? Probably not. But 3 months does not the market make. Even 5.5, 6 months, going back, well, probably that far, but going back into December, mid-December, everything's been almost lower left to upper right with a few small hiccups in there. Let's talk about 3 years. Down to 105, up to about 170, back down to 135, up to 165, dropping back down a little bit, little fake out back to 165, and then we're back down to 130 again. And then, of course, we're moving back up to the 150s, pull back to 135, and now we're in this large upswing that the market has seen since the end of last year, since about December 15th or so, December 20th, where now we've shot up from 140 to 180. You think of AMD, went up from 96 to about 205 and is wavering around that price right now. NVIDIA, things of that nature. That's what we've been seeing. But what can we just see from this chart? Without getting into the numbers, without getting into analysis, just talking about the structure of a married put, owning the stock and having a put in place that controlled the risk at any point to maybe only 4, 5, or 6%. Then as the market moved up, we're able to roll up that put to lock in higher profit to where the risk might only be 2%, 0% what we call bulletproof, or a negative at risk, which means a guaranteed profit with still having the unlimited upside. We can go back and we can say that yes, he's still up from $79 without the put. In the runs up, if the dividend percent is the same, well, the return is going to increase. Dividend 5% on a $110 stock is much less than a dividend of 5% on a $180 stock. Costs are going up by rolling the put, as he mentioned, but he still should be making 40 to 60% of the underlying gains of the rolls. Probably at this point, since you probably already have a locked-in profit and a bulletproof status, you're probably making closer to 50 to 60%, possibly even 70% of the unrealized gain in the stock when you move the put up in price. As we talked about, specifically with the last few months, selling the calls runs the risk of being assigned, which is not the outcome that you want on these trades. So that would have to be bought back and rolled for further cost. Now, we saw a lot of declines over the last 3 years in the stock, even though you still have that fantastic cost basis of $79. So if the dividend percent is the same, again, the return is going to be decreasing in that time. What's going to be increasing is the put, which is really a second working asset. It's not just insurance, and it's not a wasting asset. It's a second working asset in your favor. So when we see those pullbacks from 180 to 150, your put might have gone up from an $18 purchase price to $32 or $33. That's hedging not only the dividend that you're missing, but it's also hedging the loss on the stock. You can manipulate the put now the other way, move it down in price, which will lower your cost basis. You're essentially averaging down but getting paid to do it. That's income method number 9 in the blueprint. So, in our opinion, just like you said in your initial question, you want to be able to sleep at night. You want to have that protection in place. Is the cost worth it? The cost of insurance is always worth it. We bemoan the cost of insurance, don't we? Home insurance, car insurance, because most of the time, knock on wood, we don't need it. But when we do need it, we need it there. Otherwise, the out-of-pocket cost, the drive down that we see is not what we want for our account. So that's why we would say that this is the strategy you want. It doesn't have to be managed as often as each time it moves up in price. You can choose to wait for a better price. You don't have to roll it down each time it moves down another strike or moves down slightly. You can wait for a better opportunity when you think it's bottomed and is going to show a turnaround. But again, this is the strategy we feel, Mark, that you should still be in for your goals and for your intentions. During the strong periods, yeah, I can understand it. You're feeling that, why do I have this put in place? I don't need it. Everything is swimming along perfectly fine. There's probably not going to be another 2008 and 2009. There's probably not going to be another 2020. There's probably not going to be another volatile year like 2022 where we were flipping up and down every 2 to 3 months based on what Powell said in the inflation. Well, I've said that a lot of times now, 3 or 4 times, and those keep happening. Better to have than not have. Better to have, excuse me, folks, the protection than to not have it. That's our opinion, and I feel confident that Ernie would say it the same way. That sometimes you don't even need to roll or adjust, but definitely, I don't think you want to get more complicated. I don't think you want to start selling calls against the position by themselves, because a lot of those run-ups you would have found you were adding more cost to the position by having to move the call up and likely further out in time. Oh, you can roll for a credit. Of course you can roll for a credit. But you might be going from a 1 month out expiration in your call or a 3 month out expiration on what was an out of the money call, now out to 12 months to 15 months. And now you're just waiting and waiting and holding that call sold against your shares to look for a good buyback cost. Well, the stock might still be moving up because you have no intention of selling it. Okay. Now, on that note, let's just take a look at some other content. Real quick look there, because we want to just navigate over to our YouTube channel. And we are going to take a look at some of that recent content I just mentioned related to income method number 4 and others as well. All right. So here we are taking a look at the YouTube channel. Let me just make sure that that went incorrect. There we go. For power options. And we're just going to go ahead and before I even do a search, here's one for you, Mark. Delving into income method number 4, manipulating the second asset. Question came in last week about, should I always continue to move up income method number 4? When is it best to use it? What we look for as far as trying to find that debit to increase price ratio to be only about 50%. And when might we look for that to happen? There we go. So we just look income method number 4 here on the power options channel. That's much better. And here you have some other ideas, the pros and cons of income method number 4. There's the income method number 4 one from last week. And then even, Mark, when to stop using income method number 4 and other concepts. So those are just some basic other ideas, basic other presentations you might want to scroll through and take a look at. But again, as I mentioned, we feel here that you're doing what we would say you should be doing. Whether you asked us during a coaching session, whether you asked us during a phone call, whether we applied more in-depth via email or less in-depth even via email, these are the same types of approaches. Using that married put, rolling the married put up in price in those situations. Yes, we know the costs are going up, but when we look at the 3-year chart, we see the many uses that you would have for that income method number 4, having the put in place, how it would have saved you, how it would have helped with the decrease in the dividend and the decrease in your cost basis, where you still have the ability to get a lower even potential cost basis on the position by the value of the put in those declines when you think the stock is bottomed, using that income method number 9 approach as well on the opposite range.